The U.S. economy grew more slowly than initially thought during the first quarter of this year. The second reading of first quarter GDP showed growth of just 1.3%. That's the slowest pace of expansion that we've seen in nearly 2 years. While growth stalls, inflation over that time has been pretty consistently surprising to the upside. Our next guest does not see a rate cut until December. Michael Gapen is the managing director and chief U.S. economist at Bank of America. Thanks so much for joining me.
Thanks for having me on.
So when we have slowing growth and higher inflation, you get this stagflation conversation that starts to come out. How do you think about that equation?
So we would push back on the stagflation argument a bit. Most of the drags on growth in the first quarter were related to inventories and trade. Those are generally volatile and will reverse. We'll take the signal from final sales, where domestic demand is, and that was a number that was still closer to 2.5% to 3% in that range. And so, yes, the economy moderated from its strong pace of growth in the second half of last year, but we would lean against the idea that this is stagflationary. We might characterize it as maybe demand is showing through in a way that's keeping services inflation firm and poses a slightly different mix and risk, but I'm not convinced it's a stagflation argument.
Well, then let's try and understand the consumer and the consumer spending part. We did see a bit of a slowdown there.
That's right. Our outlook would be that growth in the economy should moderate. And one of those factors would be that what we would call the catch-up effect in employment should gradually fade, right? So services employment in the U.S. is still running below pre-COVID trends. So there's still a lot of demand for labor in the U.S., but that should moderate over time. So as we look forward for the consumer, into the remainder of this year and next year, a little less employment growth should mean a little less consumption growth, but it should still be enough to keep the U.S. on a strong recovery path.
So is that a landing at all? Is that a soft landing?
I guess you could put us in the no landing camp in the sense that we don't look for growth to slow significantly below trend. We think the economy will kind of decelerate from maybe 3% last year to 2 to 2.5% this year, and maybe 2% next year. I still think that's a very healthy economy. And so, yeah, you could put us in the so-called no landing camp.
When did you come to the conclusion that December is appropriate for the first rate cut, and contrast that with what everybody thought at the beginning of this year?
Right. Well, I would say that when the first quarter inflation data surprised to the upside, we had to decide, is that real or statistical, if you will? Some of it's noise, but we think that there's enough signal in there to keep the Fed on the sidelines for longer. So in our inflation forecast, we don't have services inflation taking a major step down or its next step down until August. And so that would be 3 months of softer services inflation by the time the Fed met in December. So that's how we got there. So we were debating between December and March. We do think an economy that's still growing fairly robustly and adding jobs will likely mean that services inflation is stickier. So the Fed cuts later and maybe even cuts less.
I guess we should underline the point that even though we saw the slow growth this year, you're not saying this is us skidding towards 0% or recession.
That's right. I would say in our view, you can kind of put very low probability on what I'll call the two tail events, that the economy is about to roll over. Fed cuts will come soon and very rapidly. We don't see that given the state of the labor market. And then in the other direction, I think it's right to believe that the risk of rate hikes is low.
Well, that was just going to be my next.
Is high, but
that was going to be my next question. We've heard utterances of rate hikes by some Fed members, and I wonder, how you think about that, and what is the bar, to your point?
Yeah, so certainly it's not a zero risk, and it's something we always need to be concerned about. But if you're getting a positive supply shock, which we still are, and you expect employment growth to moderate and the contribution from fiscal and business spending to slow, and you think monetary policy is at least a little bit restrictive, we think it's right to believe inflation will be in a flat to downward trend. So the next move should still be a cut, as opposed to thinking inflation's about to reaccelerate, which means the Fed has to come back to hike. So I think it's a combination of all of that. Could the Fed hike? Yes, but it's probably more of a 2025 story than a 2024 story. And our view would be no, that the next move will be a cut.
How does politics, the fact that it's an election year, complicate or complement your view of how things unfold?
Sure. I mean, putting a rate cut in December is naturally after the November election. Right now, we would just say it's about a coin toss in the U.S. It's hard to know. And so we would just say after November, there is greater uncertainty around the outlook, and we'll have to see, is it a divided government outcome? Is it a sweep outcome in either direction? So we'll have to see. Right now, we just acknowledge that, yes, we're putting the rate cut path in a period of higher uncertainty. And we'll have to see how it plays out.
You know, there's been so many questions about the effectiveness of monetary policy, especially, you know, how much, and I'm sure you lived this, how much your forecasts have to change. You think one thing is going to happen and then another. Is monetary policy basically doing the job it is supposed to, meant to cool the economy, meant to bring down inflation? Maybe it just took a little bit longer?
I think that's part of it. I would also argue I'm not convinced monetary policy is as tight as some Federal Reserve members think it is. And I think the committee's roughly split on this. It came out in the meetings and some public comments. I think there is a group that's more confident about where inflation is headed. I think you could put Chair Powell in that group. Others, I think, openly question, where is the neutral rate? Is it higher than we think? So maybe policy isn't as restrictive. I suspect everyone on the committee, and I would agree, thinks that monetary policy is restrictive. I think the question is, how restrictive is it? And is that enough to get inflation where you want it to go? And I think that debate is ongoing.
And I guess that question that you must get is like, what is the neutral rate in this cycle? And is it going to be elevated, and how elevated?
Yeah, so we would agree with that in our easing cycle, we have the terminal rate finishing around 350 to 375. So it would be a higher for longer outlook, right? So we are saying policy needs to be tighter, more tighter than we thought previously in order to get inflation where the Fed wants it to go. And so I do think in this easing cycle, it's right to think that maybe the terminal rate's higher than it otherwise would be, either pre-COVID or even